There is, in fact, a few people we've met in the last 4 years in lending who say that when we talk to them about fraud, that, as Anne-Marie knows, that they don't have any fraud. And I said, wow, congratulations. You don't have any, can we talk about your credit losses? Ah, right, yeah. So there is a bit of a difference, and we'll try to get into that. Introduce the panel first. So on my immediate left, Stephen Dickow, CEO of Santander Consumer Canada. To the left of Stephen, Drew Mulroy, VP Operations at IA Auto Finance. By the way, I'm going to get a lot of trouble in my moderating today when I say AI instead of IA, because we did that a lot yesterday, so just to be clear. And then Paul Hunsley, Head Automotive Finance at Eden Park, which is part of Fairstone Bank. So the one overlap I think I want to start with that the last panel talked about, John specifically, but I think was a lot of discussion on this concept of bust outs. And that's something that we, and I think others have been dealing, I think if there's one issue that's causing the biggest losses right now in lending portfolios, either at the point of origination or even within the existing book, it's bust outs. And I think what I wanted to do really, maybe for Stephen, if you want to take this on, is maybe talk a little bit about this problem and how it manifests. And then I think if we, as the previous group talked about, just sharing ideas on this, because it's not a zero-sum game. Like if you avoid it today, then someone's going to get hit tomorrow. That's bad for the ecosystem. So maybe we could start there, and then I think we'll segue a bit into more kind of the boring, the credit stuff. So fraud seems to be so much sexier, but anyway, we'll start there and we'll see where we go.
Yeah, thank you so much. So as I think about bust out fraud here, and I think the panel we just saw spoke to it really well. This is a really complicated problem. I don't think there's any silver bullet solution to solving this here. This fraud is really difficult to identify on the face of it. Some of these bust out cases that we see, they've passed ID verification. The bureau looks good. There's been no derogatory credit or items like being identified on it, and so there's nothing obvious to us as a lender to identify that we shouldn't move forward with the deal. Really what's happening here, and once again it was spoken to, is there's a lack of data here. What's happening is that when we look at the bureau, we can't see that IA has recently funded an auto loan. Eden Park has done an auto loan. There's a delay on the reporting, to the bureau, and this is one of the weaknesses that we have here. And so I think part of solving this solution is getting more timely and accurate information that comes from, both sides of things, working with the portals, the bureaus, other third-party data providers, into getting the insight as to what can we see about this customer to flag this to the lenders early. For us as a lender, what do we need to be reporting back and sharing across these other parties, so that everyone has all the information possible to be able to identify this and prevent it from happening. But we even without those data solutions, we've been looking internally at just what can we do from a training education standpoint across of our credit, income, funding teams, just to identify where this might be happening. So as we've seen losses happen on our portfolio, we've taken a look and tried to identify what were the patterns that happened on that loan that might have allowed us to identify this earlier on. And there's no single attribute here. It's combinations of things that we see, but trying to take those things, raise awareness with the team, and then move it to a fraud preventions team. So what we've done internally is had the teams identify some of these things themselves where it looks suspicious to their eye, move it to another team that's more adept at screening it, and they'll do second verifications on the file, often without the dealer's knowledge, just to see if there's something there that should prevent us from funding that loan. This might involve pulling a bureau at another point in time, so checking the bureau again to see if something has come up. But even just looking at debtor searches and things on the registries to see if something has been registered elsewhere that might have identified that there's just something we didn't see on the bureau, but there is other data sources there that could have identified that this individual is taking out multiple loans back to back. So we've tried to look at both the IT solutions, but also just taking a common sense approach with some of our staff to try to manually identify these things where possible.
Just a quick follow-up. So John mentioned in the last panel, I guess the number was 1 million last year of work permit or visa holders who had their visas expiring. This year, 1.4 million. If we kind of listen also to what Patrick was saying with respect to sort of digging into that, is that something anecdotally that you're seeing as in your portfolio as well, or when you look at specific bust out cases, that there's a correlation there, and in fact maybe a strong correlation between bust outs and I guess what Patrick would call departure fraud?
I would say there's a correlation there, but it's not all of what there is. The prior panel spoke to it well, that there are these cases of synthetic fraud where can make these things difficult to identify, and it's not just a single source of issues that we're seeing.
Drew, so we'll get into some less about fraud now, and maybe think about the macro events of last year. We're kind of seem to be in a different world almost every day now, with just shock and awe pretty much on everything that is going on. How has that, say last year and maybe continuing today, impacted your portfolio's credit performance? So let's separate that from the fraud. And then how are you adapting to that? So from a model perspective, are you changing the buy box? Are you pivoting? And then what's the process then of making sure that as these events, which are pretty big ones in the course of history, how they're keeping you and your business safe?
Oh yeah. So when it comes to the buy box, when it comes to what we're looking at and how we manage our credit, I look at it as like we're floating on a raft, right? So our risk appetite is sorry about that. Our risk appetite is really the most important thing that we can have, that everybody should be aware of. That's part of that chain. Next, we want to make sure that our policies and our processes are all aligned to that risk appetite. And again, it's really important that we understand the risk appetite, we align our processes, and then, like I said, RAFT, R-A-F-T, right? So F, fraud, that's a new one for us. The new one is fraud, and that's really making a difference, and we're starting to see it. I've been in non-prime for quite a long time, and fraud was never really an issue until it was, which was about 2 years ago.
What kinds of fraud?
All kinds of fraud. Bust outs are a huge one. Bust outs are a little bit different because you get hit with them, and if you're first hit with them, you're kind of out of luck. But we got true name fraud, we've got departure fraud. All those things, they exist on our book constantly, right? So having fraud tools, partnering with someone who has some good fraud tools that can help identify some of these things, whether it's an IDV or documents or income or what have you, that's another part of our process. And then testing. Testing. Whether you divide your customers by segments, you're looking at profiles, whatever it is, you want to continuously test to make sure that your portfolio right now, outside of fraud, is behaving as it would under all sorts of circumstances, under all sorts of pressures. So testing is key. And that sits all on top of the C, which is collections. In collections, it's really important in these type of times to have a good, solid collection team that will really keep your boat afloat. And that's kind of how we look at it.
Collections, so the C word, and that's a good
C-word,
segue for Paul, because that's actually where I want to go with this one. If we think about the macro events having an impact on a borrower's ability, that's a tough one, borrower's ability to pay, and that could be people that were originating today, but that could also be people that we've already originated that are in our book. And so if we see these events then having an impact on them, what steps are you taking in your collections process then to be flexible and adapt to how these events are impacting the current borrowers in your portfolio?
Is this on? Can you hear me?
I don't think so.
Okay, good. I was thinking about this yesterday, so I don't know how I ended up opening my mouth and I got the least sexy section to talk about, but I'm going to give it a wing. I think there's a couple of things. So we all, in automotive finance, this cool, fun things are market share. Let's win the deal. Let's what's the penetration with the dealer? How do we increase our buy box to get more deals, right? That's expensive. That's all money out the door. And one of the things that we have to look at as automotive lenders is we can't start paying the bills until Jane and John Doe get an account number, right? So all that stuff up to that point is really an expense for the organization, and you start getting it back. So if we don't start thinking about how do we protect our portfolio in these weird events, we're missing a big chunk of why we do business. Now, I didn't go around the room, but just some of the faces and the things here, the name tags, I didn't see anybody with a not-for-profit organization written at the bottom, right? So we have to be very cautious about how we handle that. So directly to your question, Eden Park is a medium-sized, near-prime auto lender, and our customers are really resilient. Because they've been through some stuff, right? So one of the things that I've learned, because I have not been in the near prime area for very long, but our customers have been through some stuff. They generally know how to dig and find a way to get stuff done if we're willing to work with them. So, we started to look at things a little bit outside of our normal comfort zone because we're not that big, but we need to take on a few ideas. So the team looked at things like third-party collections. How can we scale? How can we move things around quickly? So that was a thing that we went into a couple of years ago, and it's worked out quite well for us, right? It's a lot of massaging going on there, but we can scale that pretty quickly when we need to.
Are you talking about just accounts that have already been written off, or are you talking about
No, like
people
live
that you
collections.
want to keep?
Yeah, live collections using another source to do that. And that's worked very well for us, right? It's allowed us to stop and, work on the really hard ones internally kind of thing. And then the other part too is a little bit of basics, right? Because our customers are generally willing to work with us at some point, there's a couple of things that I think we hold very true to our mandate, and that is at the beginning of the year, we're doing our business plan, and if we say we need 50 collectors to collect the portfolio, there better be 50 bums in the seats, right? Because if not, we're already failing, right? So that is a thing that we've looked at very closely, is make sure we have the proper manpower based on all the effort that goes into here's our business plan and here's what we're going to do. If we've got that number right, then let's make sure we've got the staff to handle that appropriately. And I think that was when we started making people more accountable to make sure that we had the staff in place, we started to see better results. And the second phase of that, which I thought was really important, and this is something that I kind of new for us, kind of new in some of the businesses I've worked in the past, is we implemented some trainers. So, turnover in collections is something that's just a lot. There's a lot. And by the time people leave and you find another good candidate that wants to do that and wants to stay, it's tough. If they leave within a year, you're starting it all over again. So we implemented a deeper training process. So our turnover has changed dramatically. And the net result of that is we have much more experienced collection staff in-house working away, and they stay longer.
Is I'm not going to say IA, I'm going to say AI. Is AI playing a role at all, either now or on your roadmap as you look at, because you talked about a lot of potential problems in collections that have to do with turnover, training, things like agentic AI are kind of just front and center for that. Is that something you're experimenting with now or potentially on your roadmap for collections?
Yeah, so it's I would say it's on a roadmap. We still we're not very big, so we do a lot of things. I'm not going to say old school because I think we've matured a lot in the last couple of years, getting down that path, and certainly having a more open mind to looking at new technologies. One of the things that was interesting with Eden Park, I didn't realize until I joined, is they were signing up and doing business with a lot of vendors that were ahead of their time before others were signing up to do it. Now, it didn't necessarily do a lot with them, but we're certainly looking at that. So some of the more mundane tasks that we're looking at, specifically like from a customer service standpoint, being able to make notes quicker and all that kind of stuff so we can get the calls moving more rapidly through the process. We are looking at that kind of technology.
Can I pull on that AI thread with you, Stephen? So, because I think we have a global bank here that operates in, you tell me how many countries, but I'm going to guess 50 or something. Yeah. Is that about right? Yeah. Good guess. And AI clearly is being deployed around the world. How is that kind of coming into your operations in Canada? Like, and really just take it however at whatever sort of ground level, 10,000 or 30,000 feet.
Yeah, I'd say at the global level, there's a big push on AI. The global bank is a believer in this technology. I think it still comes with its challenges. There was some surveys I've looked at, and even speaking with local partners as to how they're deploying AI and what's working and what's not working. I think of a survey that came out from PwC last month, speaking to CEOs about their adoption of AI in Canada and the success they've had with it. MIT had a similar release sometime last year. But there's been a lot of spend in AI. The return on investment hasn't been there. I think the PwC stat said less than 50% of cases have had a positive ROI in terms of AI deployment. The MIT report was much more sour. It was about a 90% failure rate. So, there's a lot happening and a lot of capital going into these technologies, and the improvement in revenues or decline in costs hasn't been seen in a lot of organizations. Now, with that said, I am a believer of this technology. I think as I look at it, it's amazing, some of the things that it can do, but I don't today look at these solutions as being, fully end to end and working, perfectly. I think they're great supplements to increase productivity and to help staff. And so a lot of the tools that I see are working in different geographies. And once again, as I speak with other FIs, is really what can you deploy to help an agent? So we look at things, say, on the collection side of things, not to automate or have, full AI bot, speaking with the consumer, but to work with the analyst, be pulling up things like aspects of your policies. So if you have someone on the call, it's doing a live transcription of what's happening on the call. What is the consumer saying? The AI can be offering suggestions as to how do we deal with this file. But in the end, there's still a human involved in the process. It's supplementing, making them more productive, making them more intelligent in their decision making, but not fully handing off that process to an AI today. We'll probably get there, down the road, but there are a number of errors that some of these models make. I think everyone's seen, examples that have popped up in the news where it's sort of ChatGPT said what, or what did it do, and for us as a regulatory compliance standpoint, I'm not fully prepared to hand things over to a machine without being able to fully explain, what that machine is doing, or seeing that it has a 100% success rate on it, especially as it relates to certain key processes in the business where there's going to be a high level of scrutiny from a compliance and regulatory standpoint on it.
Yeah, and regulation, I think, is certainly front and center too when you get into AI model and AI model validation. And if you look at the latest OSFI guidelines, which are coming into effect next year, wow, you're going to need a navigator to just read that roadmap, let alone actually figure out what to do with it.
Yeah. And that's where, once again, having a human involved in the process, I think, helps, right? Because you're not fully handing things over to a machine. You still have someone who has the subject matter expertise, has a professional judgment there to stop, a process from happening before, something has gone out the door.
Thank you. Drew, we're going to switch gears and get into one of your favorite topics, I think, is income and employment misrepresentation. I didn't say fraud. I said misrepresentation.
My favorite topic
right?
is collections, but
multi-syllable. So instead of saying
income
fraud,
and funding we'll do.
So given the difficulty to catch and kind of like how this plays out, a lot of this typically would get reported as a credit loss. So it's not even identified then as misrepresentation, white lie, or just outright fraud, which in many cases it actually is. So as you look at that, how do you think about, like, measurement is one thing, right? Because you can't fix something unless you can actually define it, understand it, and measure it. So there's that. But then once you do that, What tactics or things or strategies are you following to be able to mitigate those risks while at the same time deal with the basic necessities around dealerships, which is, speed. Give me speed. Don't put anything in my way. And then the competitive kind of pressures then that puts on you if you're going to be introducing friction into that.
Yeah, the ever popular income waiving is
You should just waive income on everything.
on everything.
Right?
Right?
Yeah.
That's the challenge, and that's the desired end state in some situations is to waive everything, and it's just not possible. When it comes to the income and income in particular. I think that's something that, it's been going on forever. People have been, they've been writing down, I pay this much for rent, I live at home, where they don't, any other kind of document fraud. But income, let's give myself a little bit of a raise, so I can get that nicer car. Those are a lot of the small F frauds. And although the human eye is good at, seeing obvious counterfeits, the technology that's in place today, I know even myself, I was just playing around with it with my kids, and I could make videos with them in it and not even take a video of them. It's crazy. So the new technology out there, there's no way that a human could actually tell the difference between an ADP pay stub that was made by an AI versus an actual one. It's going to be incredibly hard for the human eye to do that. So I think what we're doing and what we're looking at is where can we partner with someone who is a professional in this area, where they have that expertise and they can help us, whether that's through technology or through systems or what have you, or IA, fire with fire. Did I say that one right? AI. I didn't.
Now I'm confused too.
So that's kind of what we're doing now is we're trying to investigate where can we be better, because we've been successful at stopping many bust outs. We find all sorts of weird looking pay stubs and paperwork that come through the system, and we're able to identify that. But what we don't know, we don't know. And to your point, there's a lot of fraud in that in your PCL, in your write-off. Whether that's the small F fraud where people are making slight changes just to give themselves where they have every intention of paying the loan, but they just want to give themselves a little bit better of an advantage of getting that or being approved, versus, where there's organizations that are making pay stubs, handing them out, selling it. Huge fraud kind of operations, which are a lot more dangerous in my mind, and that's a bigger F fraud, right? Because the intention there isn't to maintain your payments and to keep it. It's something totally different.
Yeah, that's the difference between ability to pay and willingness to pay.
Willingness to pay,
So credit
yeah.
models are going to work on the ability to pay,
Yeah.
but then they're going to fail around, because willingness is a behavior, right? So and if that behavior hasn't happened
right.
previously, then how do you predict that?
And that, you can't. You just got to be careful. You got to Paul's point, you have to have a strong collection team that can identify these things, hopefully quick enough where you can actually take action on it. Chances are, your car is on a shipping container somewhere headed across the sea. But, the only thing you can do is try from that perspective. And if you have everything in place to do so, your chances are better than not. But yeah, for us, it's looking at a partner. Because we're not experts, and trying to be experts in this is not going to happen.
Okay. Paul, you're going to get the last one here. We've got about 2 minutes, but speaking of partners, maybe we'll talk about your dealer partners. And this is a bit of a forward-looking statement, perhaps, or if we could give you a wish for one thing or maybe a few things that your dealer partners could do in partnership with you. We've been talking about credit losses before. We're talking about fraud losses. And that's what this is, I think, is an industry, an ecosystem, lots of symbiotic relationship then between these different constituents coming together to understand and solve problems. But maybe just a couple of things from you, if there are things that they could do better that would help you basically just underwrite more of the good people and stop more of the bad people.
Yeah, sure. I think if this feels like it may be a little kumbaya moment, if I could get everybody to work exactly the way I would like them to do it, right?
But is that an alignment issue then, like that you're kind of pulling on to say that as long as we're aligned and we're not misaligned in the sense of our relationship, you're a lender relationship with a dealer?
So I think one of the things, I think it comes down to transparency and why are we doing the things that we do, right? So as a non-prime automotive lender, we deal a lot with independent dealers. That's a big portion of our business, and certainly franchise stores and so on and so forth, but probably to a little bit less of an extent in the grand scope of things. And if we could get aligned and be more reasonable with regards to what are we both trying to accomplish here, right? Because the pool of non-prime customers every month that we look at through all of our, like our portal partners, it only swings by like maybe 2,000 in a heavy month up from what the average is, right? So it's not like there's these monstrous amounts of deals available. And the part that has always amazed me a little bit is we've got a lot of dealers that are out there solely for the purpose of selling vehicles to non-prime clients, right? Because that's their niche market. And then there's companies that are around that are solely here to finance non-prime customers because the prime customer doesn't meet my margin requirements, right? So, and if we can't get together and actually have that conversation, that like if you do your thing and I do my thing, we are going to make some money and we're going to do this stuff, and the consumer is going to get their car and it's going to be legitimate. But the minute we're not truthful with each other, like if I'm not telling the dealer why I don't want to do business with them anymore because I found some stuff, right? That's no good for a reputation for a business. And if the dealer starts, giving us deals that are just not good on purpose, they start limiting their access to lenders, right? There's not that many of the lenders like us that do what we do around. So I think my big thing would be let's focus on the transparency piece and let's work for, how do we maximize the value? We're in this little niche bucket and we can exist very well in that bucket, but we're gonna have to work on it.
Thank you, gentlemen. Appreciate your participation. Great discussion.
Thank you.